Hey everybody, welcome to Trading Capital. It is May 12th here on this Thursday afternoon. Jumping into the S&P 500, it was another down day for the markets, and I'm just going to start off with some longer term analysis before I jump into the daily and intraday action. So looking at the weekly chart on this S&P 500 here, we have clearly seen relentless selling after selling after selling. Now there comes a point where the markets have to get some sort of technical bounce, as long-term investors will find valuations more attractive, as a lot of companies have been beaten down. Now specifically big cap tech have been beaten down, small cap tech, medium cap tech, and we're really starting to see a majority of the sectors, even the strong sectors of 2022, start to put in topping patterns, which is a dangerous signal that once the strong sectors of 2022 start rolling over alongside the weak sectors, it will put a lot more pressure on the overall markets. So just analyzing the spiders here, it's had 6 weeks. Every candle here is a weekly candle. 6 weeks of downside pressure, consecutive downside pressure. So to think that in 6 weeks, so just a little more than a month, the spiders were trading at the high here. They've now fallen 16%. That is a tremendous amount of wealth that has been wiped out of the stock market. And I believe my fundamental researcher told me that it was roughly 23 million since the start of this year has been wiped out of the stock market. That is just an astronomical amount of money. And when we are on a 6-week time count to the downside, I wanted to look back in history to see where we experienced 6 weeks of consecutive selling in a row. Now we are in the camp that you get a bounce, and I'll show you why on the daily chart. But essentially, when we go back, and this is a little bit of a long-term channel that I'm watching closely because it really defines pivot highs and pivot lows. So if we look at these charts here, we had here in 2011, also in April, May, so roughly the same time frame that we're trading in now. You had 6 weeks of consecutive downside, and then you had a big pop before you had a massive rollover. So you had one occasion there, but all the way going back to 2011. Then what's really intriguing and interesting, or at least interesting to me, is our next 6 weeks of consecutive downside happened here in June of 2008. Starting in May and going to June. You had 6 weeks of downside. You had a little bit of a few week relief rally, and then you had a massive tumble to the downside here, which was the housing crisis. So you've had two occasions there where you had 6 weeks of downside, a small relief pop, and then a massive sell-off. So just keep that in note. And then what's really even more interesting, in my opinion, is we go back to the 2000s. And most people will remember the dot-com crash, but there's a lot of investors and traders, including myself, that I was not trading during this time, but I love studying this era because the chart patterns and the cycles are lining up very similar to what we are experiencing now in terms of price and PE compression that we're currently undertaking in the stock market. So here we had 6 weeks of downside, a huge relief rally, and when you look at this rally, I mean, it's a pretty powerful one. It's a good 9% in the spiders, versus when the sell-off happened, we sold off 12%. So that's just the percentages working out, a 12% decline and 9% pop. But after this 6-week decline, you had your pop, and then you had more decline. And then look, you entered another 6-week cycle here. 8. An 8-week cycle. And that was one of the larger sell-offs before ultimately you had a massive rally and pop. And then you started having the true dot-com correction and crash. So it's interesting to note that what precedes 6 weeks, when you have 6 weeks of downside pressure in a stock market, it clearly demonstrates we are in a bear market or entering a bear market, in a recession. Some people don't like to declare that we are in one, but I'm not going to sugarcoat it. I certainly think we're in a bear market, and there's certainly a lot of money to be made in a bear market. by playing these rip-roaring rallies, but you just have to be nimble and play it very carefully, and less is more in this environment, not over-leveraging into one specific stock, thinking you know the exact price level that the stock is going to bottom at. But so overall, the correlations to when you have a 6-week time count to the downside, over history in multiple different years, it is shown that when you have 6 weeks of downside in a row, it ultimately is favoring that we are entering some sort of potential stock market collapse. And I still think we're roughly at the midway point of this collapse, but we still have a little bit more to go. But from those previous observations throughout the stock market history, we do get bounces. And that's what I think we're getting now, is when we flip to the daily chart, and I'm just going to zoom out here. When we flip to the daily chart, you can see that the spiders had this relentless selling pressure all day, all day, all day. And again, you're on 1, 2, 3, 4, 5, 6 days of downside. You had your 7th gap down lower, and usually a gap down in the market signifies a temporary capitulation zone, a wonderful temporary bottom to trade against. And look at the volume on this spiders today. This volume candle precedes all of the sell action that occurred during this down move. It also precedes all of the sell action that occurred during this down move. And your larger red volume candles start only coming into play around here. So in my opinion, it stands to suggest we've put in a temporary short-term low to trade against, and we are long. That's why we've been accumulating beaten down names. And this is your new resistance point, which is going to take you to your largest red volume candle at the closest period of your chart. Just so happens to be a pivot low, a major pivot low area here. And this is where you were consolidating bearishly for a few days before breaking down. So it makes sense that you retrace back to the original breakdown zone, and that would be an area that we potentially start to look to unload all of our longs and actually acquire more shorts on the market. And if you see here, you hit major pivot here, chop over here, and then a major pivot high here. So I do think we have that temporary support. What's interesting is that you have pierced this long-term channel that we've been trading in. So again, that channel is going to act as a little bit of support since you are in an oversold condition at the moment. Jumping into the NASDAQ, QQQ. Actually, we'll do the NDX because QQQ is fine. Whoops, no symbol. Bear with my typing skills. It's been a long day, a long crazy day. The volatility sometimes, it really takes a lot out of you as a trader. Some days you go from being so quiet, no action, to other days just rip-roaring rallies, hard selling. So it's just a wild ride of emotions. But again, the NASDAQ completely oversold. When you take a look at this move from the high to the low with really no bounces, you've seen a 23% decline. From the highs, the NASDAQ is currently down 30%. A whopping 30%, people. That is portfolio destruction. It truly is. So one of the key trend lines I've been watching is this one. Connects a pivot high in 2016, 2017, 2018, your pre-COVID high, your original breakdown zone before that massive QE started gripping the system and put you into a raging bull market. You came back to test these area, kissed it again as support, and now look here. You broke that area with a clear confirmation to the downside. Now it stands to suggest your first level of resistance is going to be right on this trend line up here. If for some reason you get through that, your next level of short-term resistance will be these pivot zones here. I think that'll be a secondary big level. And then if for some reason you get through that, which I think is highly unlikely, then you have this major resistance zone up here. So you have your 3 levels to trade against. Again, we will look to unload our long positions as we approach these key resistance areas. This market is not going to make new highs. It certainly is not going to make new highs if the Fed remains on their tightening policy. If they somehow revert, we will be the first ones to know about it and will jump onto the long side of the market. But with inflation raging, with inflation still beating the market consensus, despite it did come down by 0.2% on the year from 8.5 to 8.3, the markets were expecting 8.1. So it just shows you, even with the harsh selling in the stock market, and inflation still has barely come down. So what's it going to take? Is it going to take a true recession? Is it going to create a stock market collapse? I certainly think so. A stock market collapse will ultimately wipe away most of the inflation. It will bring down all the inflationary aspects of the CPI in the sense of used cars, energy, housing. And I just want to jump into an interesting housing chart, or the IYR, which tracks real estate. So let's flip to a weekly chart here. The IYR is interesting because you're into this, and this is a weekly chart in the IYR, you're into this major support. So this was your pre-COVID high. This is your multi-week consolidation period before breaching this pre-COVID high and making this rip-roaring rally to the upside. So now you're into that level. You've tagged it here, and it looks like you are getting a short-term bounce. However, this is the line in the sand. If the markets break this major support zone, housing is in dire trouble. And I think one of the reasons why it's getting a bounce, is it makes sense, is we've slowly started seeing interest rates hit their interim short-term high, and they're now pulled back and looking to consolidate to move higher. So as interest rates have pulled off the highs, real estate has found support, and I don't think it's going to hold support for very long. In the near term, we're going to eventually see interest rates continue to break up, and this should put pressure on real estate to break down. If you notice, we do have a topping pattern here, head and shoulders formation, and this is one of the most classic, easiest patterns to spot. And the scary thing is that we're seeing this topping pattern everywhere. You might think it's one of the most common patterns. Well, it is a common pattern when the stock market and the sectors are reaching a peak and we're likely to start rolling over. You're likely to start seeing many of these patterns. So the calculated downside for this head and shoulders pattern is, if we draw the neckline in, you can see your neckline was breached here. You've closed below, and you've officially now confirmed, well, tomorrow will close the week, so you have not officially confirmed. It would take an exceptional rally to rally all the way up to this trend line to basically negate confirmation. But so I think we can safely say you've confirmed below this neckline, you've broken it, and now the measured move is essentially takes you down from that break to that break, takes you down to the 84 level here, right around this support zone down here on COVID. So let's just draw a line in there. There we go. So roughly the fully measured move of this downside topping formation takes you down to this 83 mark, which may just coincide with the center point of this channel before you find support. You can see it does prove you into all this chop over here. You have a pivot high. You have all this multi-week consolidation before breaking out. You even have your retrace back to the original breakout zone. So that's why this is likely to hit this area. So we'll just have to monitor it, week by week. But I do think real estate is in for a short-term bounce along with the markets, and then ultimately they should head lower. Let's take a look at Bitcoin here, since I haven't analyzed it. So Bitcoin, you can clearly see on a weekly chart, same thing, 1, 2, 3, 4, 5, 6, 7 weekly time count to the downside. You have found a little bit of support on Bitcoin, but the interesting thing is that you've broken these key levels. These major pivots, you broke below. Now, you haven't confirmed on a weekly basis. I do think it's highly possible that you go retrace back to the original breakdown zone. You can see on the charts, whenever you have a weekly gap, there's a high probability that gap gets filled at some point. Just like we filled this gap down here on a weekly basis by having this massive sell-off, I do think you have a bounce back up to this 36,000 area. If you get through that, the top of this trend line around 38,000. Let's flip to the daily chart. On the daily chart, you can see we've almost put in a bottoming tail on Bitcoin. That'll be very, very healthy to see if it can close above this yellow line around 29,000 mark. So we have 24 minutes left in the candle. That's what I will be watching for. If we get a bottoming tail in Bitcoin, I think risk on assets are going to continue to see some upside. Risk off assets like Bitcoin are going to continue to see some upside, potentially for a week, maybe two if we're lucky. So potentially look to see Bitcoin take us into the money. I think our average on Bitcoin is right around the 30,293. So I do think we'll make profit on that trade once we have this bounce completed. If you notice the capitulation bar down here, usually these massive standout volume bars come at the end of a capitulation cycle. I don't think it's the near bottom. I just think it's an intermediate bottom for Bitcoin. So stay tuned for more updates. There's going to be continuous alerts. Expect over the next 1 to 2 weeks, as we continue to see a potential market bounce, for us to start unloading our positions. There's a lot of positions that we've been accumulating. I mean, you saw us unload 3 of them today. We did accumulate a couple more beaten down names, but continue to be on alert for the bounce. The bounces happen very quickly, and the reversals in a bear market happen even faster than the bounces. So we just have to be nimble, be on alert. This isn't a market that you want to get cute with and stick around. You have to respect it. You have to trade the technicals. You have to inch in slowly, and do not over leverage yourself, especially in margin. The margin calls are fast and ferocious, and it truly is something to really monitor your position sizing in this market environment. Keep in mind, we also have options X next week. So with the market having so many puts against it, short plays against it, the fact that we have been in a downtrend, people have been trying to protect the downside, I do think options X is the perfect scenario where it squeezes out a lot of those short traders that have now piled on the shorts, thinking the markets are never going to get a bounce and we're just going to go straight down. But that's not the case. You clearly seen from past cycles in the S&P 500, in the 2008, in the dot-com crash, essentially what we're kind of going through now, but maybe on a bigger scale, we have bounces. We have furious bounces. Then the reason why the bounces are so incredible during bear markets is for one simple reason. It's not because new buyers are coming in, but it's because people pile on the shorts in bear markets, and at some point they cover those shorts. So when you have mass short coverings occurring, you get these crazy reversals and pops to the upside. So that's why it's so powerful to accumulate slowly at major oversold technical levels, and often you will be down on the trade, but when that rally and that bear market bounce happens, you certainly profit handsomely. So thank you again for always being members and subscribers. Stay tuned for more trading action. This volatility is not likely to subside anytime soon. Take care.